Senior commodity strategist at Bloomberg. I'm very excited about our panel today. Outlook for commodities, the world, geopolitical uncertainty. Obviously, things are quite uncertain lately, and I have the honor of being the moderator and getting to learn a lot of stuff from our panelists, and already have a little bit with our um, um, preparation. So to me, the lay of the land for commodities and broad commodities is we've just had record highs in gold and copper. Try to catch up a little bit, I think, to gold. I think they're both catching up to copper's catching up to the precious metal, but it's the metals versus everything else. You look at WTI on your screen, it's the same price as 2007. That's not so good. I mean, the high price kerosene seems to be kicking in there, following natural gas. You look at corn, it's the same price as first traded in 1996, but the metals are differentiating themselves. And now we have this situation with the headline I probably be publishing tomorrow. Is I like to compare when people point out that, oh, OPEC's cutting supply, that's good for prices. I'm like, no, they're cutting supply because they have to, because there's an excess of supply, and the demand situation is shifting in the world. And the same thing, you look at all this stimulus out of China, they're doing that partly because the demand paradigm shift in the world is tilting against commodities in the broad picture. Now, I want to be bullish commodities, but you got to just focus on the facts. So we're going to tilt over to our panelists. First, I want to mention the persons, and then we're going to go over to the first question and rotate. We'll take audience questions. We just want to try to figure out as much as we can here, have some discourse, hopefully some disagreement, and figure out where things are going. My first panelist is John Lejonvarn, Global Investment Strategist of Newtown Investment. John has a good overview of the broad picture, and we're going to dig into that. Paul Hickin, Editor-in-Chief, Petroleum Economist, Carbon Economist, and Hydrogen Economist. I mean, that's some cool stuff. I mean, it's got to be cool to be a hydrogen economist, Paul. I'm looking into digging into that with you. Because it sure seems that things are going that way. I'm also on the back of rapidly advancing technology. And Mark Burridge, CEO and Portfolio Manager of Baker Steel. So I want to start with Jason to give us an overview of the land from an investment, from your strategist standpoint, what you're thinking and looking in commodities. And maybe you can push back on me a little bit. As I look at broad commodities are in the early days of coming off that high price cure from the peaks in 2022. And one good example is natural gas at least got to the low price cure in the US and it's bounced. I'm still afraid crude oil hasn't done it yet. And I'm afraid corn hasn't done it yet because we still have to get through the growing season. So that's my views, what I'm looking at. But Jason, what's your thoughts? What's your lay of the land for commodities? Where do you think things are going? And what can we do to maybe profit in this exciting environment?
Sure. So here at Newton, we have both, broad long only or dynamic beta type solutions for commodities, as well as simple long short commodity solutions. For us on the commodity beta side, surprisingly, we're neutral commodity beta. So to be clear, we would still put commodity beta in our multi-asset portfolios, but we wouldn't overweight or underweight that commodity beta. And in a second, I'll sort of talk about the reasoning there. But effectively, the curves have gotten much flatter, and essentially the roll yield, which was quite high post COVID, at levels of high of sort of 10 to 15%. Now that's come down to actually below zero. So this means that the shape of the curves are essentially against you. So the shape of the curve is essentially positive. So as you roll, essentially you're going to get a negative roll down as opposed to a positive roll down, or in the case of commodities, roll up. So we're less keen on overweight commodity beta. The area where we're actually quite keen on in terms of adding alpha is in the long short space. So pun intended, I think we're in the golden era of commodity alpha. To some extent, I think it's been the forgotten asset class. There was a bit of a wake-up call in 2022 when commodity beta was essentially the only thing that worked in the liquid space. I think now, thinking about inflation, higher for longer, investors are now looking for liquid inflation hedges in their portfolio. And again, commodities in the liquid space is one of the few asset classes that has a high beta, as high as about 8x to inflation. A comparison would be, say, equities that are about 2. Interesting in gold and tips are about 0. So the first thing is less keen on commodity beta at the moment, overweight commodity alpha. And then I would say the other thing is the diversification of the third thing is the cash return. So effectively what's happened is you've had this big discount rate shock, and that high cash rate has eaten into the premiums of your main asset classes, principally equities and bonds. So essentially you're getting less premium in those asset classes. People sometimes forget that actually commodities implies you own the future, and then you post collateral, and the rest of your money is essentially sitting in cash. So commodity futures will get you that cash return as well as that that future return. And cash rates are high. Cash rates help you hedge that inflation. So I'd say the third thing is don't forget about the high cash rates and how commodities benefit from those high cash rates.
Well, I want to tilt off of that right away, because high cash rates to me right away means contango. You just look at gold. 1-year futures curve is about 5% in contango. You have to price for that carry. Crude oil looks like it's finally tilting back that way. Natural gas was the leader. We had that recent backwardation at copper, which could put in a pretty good peak. And so I want, before we tilt over to Mark, I want to go to Mark first in metals, and then Paul in petroleum. I got to ask you the question. So alpha is great to say, but does that mean were you part of selling copper when it got above to a new high in the U.S. around 520, and were you on board on cocoa? I mean, to me, how do you get your decisions on where to buy and what to sell? So here's a key thing I pointed out is crude oil got very expensive beginning of the year. You can see that for managed money net positions, potentially peaked around 87 like it did in 95. I mean, so for alpha, what are you thinking? What are you looking at? What are kind of the next alpha triggers you're looking for?
So when we build an alpha portfolio, essentially we've got a set of different types of signals. So your kind of core signal is going to be a carry signal, and that's essentially going to denote the shape of the curve. So if the curve is backwardated, essentially you're going to have high carry. If it's in contango, as you mentioned, it's going to have low carry. But then in addition to carry, you want to complement what we call behavioral signal, which should be more kind of positional signals. The other will be trend. And then the other will be what we call valuation, which is essentially looking at the price behavior within its peer group or within its pairs relative to its history. I mean, at the moment, our portfolio is rotating. So we were essentially long softs and long energy in very short ags and kind of neutral metals and slightly short precious. Now, essentially, we're rotating less in softs. Obviously, cocoa's come down, sugar's going south. We're putting more into ags to kind of neutralize some of the shorts in ags, and probably a bit more bullish on the metal side, particularly on the precious side.
But with that, let's tilt to Mark and metals. Mark, more focused on the equity side. To me, I look at it as an index provider, person working at S&P. Then to me, the ideal commodity exposure is long the underlying metals, like an all metals index, because you can, they have the low elasticity of supply and the easiest storage, and also maybe long some equity, energy equities, energy and more natural resource equities, because you don't have to mess with the contango. So Mark, the key thing I've been sensing in all the conferences I've been going to lately, I'm in New York this week for the SME Metals and Mining and Money Conference, is the underperformance of the equities versus the underlying metals. And the disdain from people, it's going to catch up and things like that. So give us a lay of land, what you're thinking in metals and wherever you want to go. And I do want to tilt obviously over. My sense is almost all of them are just catching up to gold, but the autocorrelation risks in copper are much greater risk than things like gold.
Yeah, I think it's a very interesting question, and we actually get that quite a lot from our clients. And we, our core strategies are around precious metals and what I call future-facing metals in the firm here. So and the equities of those companies. So it's really interesting, that comment you have to say about the catch-up trade of equities to where commodity prices have risen, and there's that degree of undervaluation. I think, but coming back perhaps to that sort of big picture view of, is it time, where commodities fit in the broader asset allocation mix. We are a little bit of an unprecedented time globally in terms of what some of the demand drivers are for these underlying metals. And I don't know if that's been fully appreciated yet, and maybe one of the reasons why there hasn't been a run towards the equities in the stocks. And I think you can see that perhaps most clearly in gold, where gold has set a new record, yet in an environment where real rates were still high and the rate, the rate cut, first rate cut was being pushed back, and that's sort of counterintuitive if you think historically how that's behaved. And that's been supported by strong levels of fundamental demand, ranging from Chinese central bank to retail gold, physical gold buyers in the US. So what you've seen is a bit of a paradigm shift there, where yes, ETF buyers of physical gold in the West have behaved as you'd expect at this environment, but retail buyers and non-Western buyers actually flock to the metal as a financial real asset, safe haven, call it what you want in terms of its traditional role. And what that means, it bodes really well for what happens if and when we do start rate expectations starting to turn the other way in terms of another wave of buying. So I think there's lots of reasons, I think, to be, from a fundamental perspective, be positive about gold. For copper and some of the industrial metals, but not all of them, you've got a similar shift, sort of happening on the demand side, which really is, I wouldn't say unprecedented, but very different. I think the massive push towards net zero renewable energy and battery storage means double-digit demand trends for renewable energy infrastructure, and that means double-digit demand trend for the key metals that are needed to build that infrastructure. That ranges from copper, which we all know about in terms of you need a higher intensity of copper usage in a renewable energy grid. Silver playing a key role in photovoltaics. Lithium, everybody knows about in car batteries. So there's an unprecedented double-digit underlying demand growth in these metals, but I think the problem is it's not in the mainstream yet in terms of looking at the underlying equity. So that's been the first problem of equities actually playing catch up with where it's at. I think the second thing is the metals basket has been very mixed. If you look at last year, for example, uranium doubled, but lithium halved. Both are key metals for the sustainable energy future. Both have great supply-demand outlook over the medium to long term, but you saw a completely divergent trend because the nuances of supply-demand trend within those individual metals. And then the third reason that I think equities have underperformed, and this is being proved to be wrong, is that it was felt that the mining companies themselves were going to have their margins eaten by inflation. Yes, they did experience double-digit inflation like many other industries, but they managed to keep those costs reasonably under control. And we're now starting to see some pretty significant margin expansion amongst those mining equities. And just to put, but that's all happened at a time when nobody's really cared about non-mainstream equities. So people haven't been paying attention to the sector for all the reasons that we are. So we think that's the combination of reasons nobody's been paying attention to equities. But actually, they're looking in good shape. I mean, if you can find value opportunities, you can find growth opportunities, and you can find yield opportunities all in the commodity space. And in some companies, you can find all three. So there has to be some kind of catalyst to I think persuade perhaps a marginal group of new investors to start looking at the space potentially is where what is needed to do that. I don't think what is happening is the equities are pricing in a negative commodity price environment. I think that the macroeconomic situation, the fundamentals are reasonably strong and supportive there. But of course, it's not the same for all commodities, as you well know. You can get huge divergences between nickel and copper in terms of direction in the space of 3 months based on different fundamentals and politics.
So before we tilt over to Mark and energy, Paul and energy, I want to ask you a question I ask at all conferences, and it seems to be on the tip of everybody's tongues, is we know that China's been one of the largest buyers, central banks, one of the largest buyers of gold, and that's from data from World Gold Council, whoever else you want to go to. Is there potential that they're potentially hoarding, and we know they filled the SPR last year, the Strategic Petroleum Reserve, but metals, I mean, why would they not be also buying some silver and copper and stuff, restocking, particularly as they try to shift away from the dollars? Any sense of that? And certainly all the panels, you guys, any thoughts, or is there evidence of that happening?
I think there's certainly a strong indication that there's a part of the world that is looking towards commodities and particularly gold as a store of value and a means of exchange. And I think that's part and parcel of it. I think it's due to, I think geopolitics plays a role in supporting that buying of gold, but I think it also plays a role in looking at supply chains of some of these critical commodities. I mean, as you know, there's quite a strong concentration of processing of commodities in China, particularly for some critical materials, although perhaps the raw inputs for that is sourced from around the world. So I think there's a couple important dynamics on that. I think the first dynamic is, yes, I think there is a tendency for strategic stockpiling, whether you call it about strategic stockpiling of a reserve asset like gold or strategic, stockpiling of particular commodities. But there's also, government support for intervention of supply chains. We've seen that in the Inflation Reduction Act. There's been some monies have been allocated to support domestic growth of critical materials in the US, and the EU has talked about similar initiatives, which perhaps haven't had as much impact so far. So there's an element of that, at least in my view. But whether you can point to that as evidence of strategic stockpiling, maybe it's more an indication rather than evidence.
So let's tilt over to Paul. I appreciate that. One thing I like to analyze when I look at the metals on a total return basis versus if you measure performance of underlying commodities versus virtually anything else, metals almost always win with gold in ahead of the game because it's basically money. But Paul, I want to tilt over to you. There's an issue I have with petroleum, and it's the lessons of Adam Smith, and the lessons we also learned that Thomas Malthus got wrong. And that's a high price cure has really kicked in. We all know the trends seem to be bad for prices. And every time I hear about OPEC cutting supply, I'm like, okay, because they have to. It's not like the demand's taking off, unfortunately. But give me the lay of the land, what you think for energies. The issue I have with crude oil is I think it still hasn't completed that normal cycle of getting to that low price cure. The last couple of lows have been below $40 a barrel. And this last pump to 130 is, it's like, all right, well, we still see the problem. Every time it goes up, the highs are lower and there's more sellers. Help me out here. Where are we going with the energy?
It's a good question because, it's a real markets aspect. We've been talking about markets as, these some of these other markets which operate in a very different way, in a sense, to the way that OPEC plus market manages. And I think that's, it tries to, it's OPEC would be the first to say it tries to provide stability to the market. There are a lot of people who disagree that it's providing stability, but the argument is that it provides stability. The Federal Reserve came out recently and even did a report saying that OPEC has helped provide stability to the market, even out sort of the booms and bust cycles. I mean, they're in the game of, you could argue, they're in the game of, pre-COVID, they had the argument that they were providing a floor and US shale were providing a ceiling. And now with US shale not operating the same way, what's providing the ceiling? Well, really only probably demand destruction and their own fears of prices going too high in some ways. And the extra supply that's been coming on. I mean, we've also talked about, and I think one of the big themes in oil has been investment, the boogeyman of an investment crunch, of the oil super cycle, commodity super cycle. It's never materialized. It's been talked about for several years, but extra supply just keeps coming on. US has come back stronger than ever, really. From that, you've got Brazil and Canada and Guyana now, and potentially Namibia as being a big new one supply. So you've got all that extra supply coming on. So it's all about OPEC trying to keep supply off the market, and it has done that. I mean, the question really comes down to, and this could probably be an argument for all markets, but for an OPEC and the oil market, it's all about trying to provide a sweet spot. You know, the Goldilocks price. Is there such thing as a Goldilocks price? It keeps shifting. The goalposts keep shifting depending on who you ask. But 80 to 90, 70 to 90 seems to be a bit of a sweet spot in the market. You know, it's something people tolerate from a consumer angle and even from a producer side. It's not easy to do because obviously you've got all these other competing factors, geopolitics, you've got all sorts of things going on, and also the macro side, you know, the macroeconomics. We haven't talked about so much on the macroeconomic side, but it's been where in metals you may have had the energy transition story much stronger playing out, helping to support it through inflation, economic weakness. Oil is, you know, oil demand has, you know, been hurt in that regard. It's been hurt by the sort of underwhelming you know, the concerns about inflation and the economic environment, and also the transition environment as well, where you talk about, you know, how strong China is going to come back from in its demand. It's reasonably strong economically, but how much is it going to buy, you know, oil, crude? It's building out its refineries. You think it's still going to use it even if it sells its products. But there are certain question marks over China, and that's often carried the can for everyone. So there's a lot in the mix. I wanted also just talk a bit about that other question. You talk about strategic reserves because it's such an important part. You talk about SPRs and the IEA for the Arab oil embargo and providing those oil reserves. And it's a lot harder to have oil stocks and reserves, and a lot more costly than in metals, for example. And it's an interesting one. It just piqued my interest, and I think, you know, given how easy it is to store metals, especially the you know, everyone talks about copper and some of the other metals as the crucial line to electrification, but you know, no one's really storing it in a strategic way, not as far as I know. Maybe someone can enlighten me, but surely that would be, you know, I'd be rushing. If you're not, you know, rushing to sort of secure the strategic metals, why aren't you rushing to stockpile it? And maybe it needs a crisis like an Arab oil embargo to sharpen the minds in that regard. Maybe there's a bit of complacency still, or like some of the other panelists have said, maybe we're not quite there yet in terms of really buying into the transition spike story, the commodity super cycle story. You know, everyone kind of sort of laughs at the super cycle story, and yeah, probably because we're going through some economic weakness. And I'd love to hear what some of the other panelists have to say.
So let me tilt over on that real quick. I think it's important that you focus on the super cycle, the macro in China. To me, those are it's overwhelming at the moment. And first, I want to get an answer from you. I think Brent is more likely to go to 60 next than 100. I think it's got a pretty good geopolitical premium. And to me, it depends every day on some kind of supply cut. Every day it doesn't get it from geopolitics. It's more likely to just go towards its cost of production. In the U.S., the cost of production is $56 a barrel for WTI. What stops that? So what's your thought? First, what's next for crude, up or down? Or push back on my thoughts.
I'm slightly more bullish than you, okay, Mike. I think it's probably going to go up. I think two things really a question is, how long does OPEC plus keep the voluntary supply cuts? We went from a position, which is interesting, earlier in the year when we were talking about, you know, how quickly the Fed's going to cut, how much inflation is going to come down, and how much is OPEC going to start, how quickly OPEC's going to start unwinding from the voluntary cuts. Now we are in a position coming up to the June the 1st OPEC plus meeting, talking about potentially, yes, the central scenario is for a rollover, but potentially is there going to be further cuts? Are they going to be changed to baseline to help provide further deepening of the cuts? And the whole idea of, well, now inflation and the macro is like, well, are we going to see interest rate cuts at all this year? You know, that the narrative's really shifted. So yes, you're right in a sense that there's that demand weakness that's carrying on, but I think while you've got OPEC at the wheel and they're really strongly trying to keep prices above a certain level, I think they're working hard. They'll continue to work hard to keep prices above 70 as a kind of floor for them. And it'd take a lot, I think, for it to start dropping way below that. And you've got to say, if they keep taking crude out of the market, supply and demand fundamentals, it should start creeping higher. I'm not saying the demand's there to really lap it up, but there is some demand, and that's going to should be enough in the second half to at least get prices a little bit inching higher. But in a way, we're in you're in a weird position where prices could be in the $70-$90 barrel range for pretty much the whole year, and that's not so exciting for us to talk about unless you're just trading the sort of intraday volatility, which, like you said, comes from a lot from geopolitical risk or just general sort of macro trends of US and China.
It's-
There's an interesting analogy there with OPEC, I think, and the metals and mining space. I think one of the things we've seen this cycle, probably with the big exceptions being lithium producers and nickel producers, but outside of that, we've seen a degree of supply side of producer discipline that we haven't seen previously. And it's not saying it's an OPEC, but where the discipline has come is in capital allocation, not building new mines. Because take the copper space, for example, people are saying the incentive price to build a new mine is $12,000 to $15,000, and we're at 10. But at 10, as you pointed out, Mike, the equities are so cheap, it's actually now more cost effective to buy and build, and we saw that potentially reflected in the BHP Anglo discussions that are ongoing. So what you're seeing here is even though the metal space isn't famous for sort of having sort of an OPEC that provides that price stabilization, we're actually seeing a sort of analogy of that happen because the producer discipline leading to the risk of real price spikes on the upside if and when supply does return, because there isn't that money flowing into building the new mines. Then the new mines that we are going to need to meet those anticipated future demands. There's not a tap that can be turned on in the copper space, for example. You actually have to spend several years and several $billion building new capacity to meet that demand growth. So it's an interesting analogy, but with some big differences in terms of the timing and what that might lead to in terms of propensity for price spikes.
And just on the crude question, I would say the marginal producers are essentially tapped out for the most part. So the U.S. growth, while impressive, is in that sort of 13.5, 14 million barrels per day range. And then essentially you've got, Iran, which is coming off a bit. And then you've got the issue with sanctions in Russia and their ability to sell oil in non-US dollars. And to what extent, they're able to continue to sell that crude and circumvent some of those sanctions. So kind of the marginal producers out there are getting exhausted to some extent. Also in the US, obviously with the higher cash rates, the cost of capital is higher. So that capital needs to be more efficient for them to apply that. And lastly, I would just say the curve, which the curve doesn't lie, but the curve looks pretty bullish. Like it's probably not going to go to 100, but if you're looking at depressed prices or depressed market, that curve would look a lot different than it does today.
Okay, well go ahead, Paul.
Mike, I can jump in a bit. I mean, I'm glad Jason's backed me up on a few points there on the oil price and some of the point, but I would actually take a slight. I'd be slightly more circumspect about some of those supply coming off marks. I mean, I think the sanctions on Russia is a bit of a false flag because effectively Russian supply is pumping as much as the OPEC Plus agreement will do, and if the sanctions have always been designed to allow them to continue supplying and pumping as much as they can. It's just that they want to hurt their revenue, so they're pushing them towards India and China.
But their incremental production has gone down since, and it may not be as a result of the sanctions. It may be just the natural decay in the quality of their fields. But it has gone down, and they've been one of the biggest losers in the OPEC Plus, reductions. And they are sitting on a lot of non-US dollar currencies like rupees, which they may struggle to find other takers of that currency. But I think the sanctions are still in place, and those effects. I mean, they'll continue to find ways to go around it, but the effects could be long term.
Yeah, and I think what you said about the US, I think you're right. I think the US, I'm not saying tapped out, but I think the speed of growth is going to be much slower going forwards. I think it's interesting one with the marginal producer. And I think talking specifically about US shale as a genuine marginal supplier, because that changed the game in terms of how quickly investment supply could come on. You talk about how long it takes metals to come on and building a mine. Well, if US shale, if we are in the mindset that US shale is reached peak or close to peak, then you're looking at where does extra supply come on. And yes, there are some good news stories with Guyana and potential and Namibia in the sort of the end of the decade. But after that, you're looking otherwise, where's the big finds going to come from, and where's the appetite for exploration? So maybe not right now, but unless you're talking about a massive transition quickly, which I guess from an IEA or policy in a net zero perspective, that's what people are looking at. We could still be in 2030 plus where we're starting to think where's the oil going to come from, and the demand's still going to be there unless even with a big EV revolution, if you buy the EV revolution, and that's still a question we could debate.
So I got to unpack on that. Let's do that. Let's focus first on the 3Cs. Start with crude. So the issue I have with crude is the lessons of Benjamin Disraeli, the former UK Prime Minister, said what we generally anticipate doesn't happen, and almost everybody who's bullish crude oil tells me the same thing. Oh, shale's going to stop having its incremental supply. I get it. And China demand, I get it. And then I look over, first let's start with the US. One of the most enduring trends I've seen in markets is, I go back 20 years, EIA data, IE data, is that excess of supply in liquid fuels and petroleum out of the US and Canada. From the lower left to the upper right, I mean, straight up. The only time it really dips is when prices dip. And we had the biggest test, and now it's back at record highs again. The excess of supply right now is about 6 million barrels a day. OPEC, as some estimates are, spare capacity is around 6 million barrels a day. That total there is about 12% of total production, which is it was almost the opposite back in 2008. So the key thing I want to point out is, in this country, in the US, we have recessionary trajectories in demand for diesel, unleaded gas, and container board corrugated boxes, and those are 52-week moving average analyzed. So from a US standpoint, Petroleum standpoint, I see nothing but headwinds for lower prices. And every day that OPEC cuts production, I just look at it from an ex-farm part owner that, when you saw the war in Ukraine, like, that's horrible, but it's great for us in the Midwest to be able to produce more and make money. And same with the shale producers. So to me, that's the problem with oil, but we've already I think we've been enough on oil. Let's go tilt over to copper. There's a question in the chat about copper, where you think it's going. So I want to start with Mark there. My bias in copper is, I think the per pound price is more likely to trade 4 than 6, at least in the short term. Big picture, yes, I get it. Everybody says the same thing: lack of demand, electrification, decarbonization. I all agree with it, but then I look at managed money net positions, futures positions, and when it popped up to 520 in copper, total LME and CME positions were the most, 32% open interest in about 4 years. And I'm like, my lesson that is, that's speculators getting in. This minute they hear people like, broad, widely known economists coming out and saying things we did, they sell, and they triggered them to sell a little bit. And I think that's the risk. It sells more, particularly if we have a backup in the stock market. So let's do a round on copper. That's my view on copper. How about we start with you, Mark?
Yeah, sure. Just maybe want to make a quick comment on that sort of crude oil story as well, because there was some, and I guess a key driver for copper demand is copper circuitry in EVs and things like that. But one of the reasons why lithium price fell off last year is EV growth was still double digit. It just wasn't as high as people expected. And I think, and we're certainly seeing that there's a potential, I wouldn't say pivot, but a shift towards perhaps more internal combustion engines and being built than people have expected, for 2 reasons. I think, first of all, there's a shift to hybrid and to range extended electric vehicles. So yes, there's smaller engines, but they still need gas or petrol. And there's also, thanks to Chinese manufacturing, the price point for small internal combustion engines has now reached the point that actually they're creating a new market, because it's become affordable for a much broader component of the emerging market population. So you're making internal combustions are becoming more affordable, and they're being used more in range extenders and hybrids. So I think there's a very interesting dynamic there where people say, is oil dead? And that's of interest to us, not because we invest in oil stocks, but because we invest in platinum group metal stocks and other stocks of lithium stocks. So that dynamic is really important. It's a bit uncertain dynamic right now, but it also plays into uncertainty over copper demand. So there's no doubt. I mean, I think one of the interesting statistics that we've seen over the last year is that demand growth for copper in the West was at a higher growth rate than demand growth for copper in China for the first time in a long time. And that's because of the deployment of renewable energy and the increased intensity of use of copper demand in renewable energy. But I think, Mike, you're right. Copper went very far. Copper went very far, not because demand surprised to the upside. Copper supply got squeezed because we suddenly lost a lot of copper production in the world. We had Cobre de Panama being shut down in Panama. We had two key mines from BHP and Anglo having reduced production expectations for this year, deferred production. So suddenly we went from a market that looked like it was in a modest surplus with the big deficit not happening for 2 or 3 years to something, the market that looked like it was heading into deficit this year in terms of supply-demand dynamics. And I think that's supported. And we saw that reflected, that shortage of copper mined concentrates being reflected in record low TCRCs, which are the treatment charges that smelters pay to the copper miners to turn the copper raw material into copper you can use. So that's a real indication that copper is tight. But copper is not tight because demand surprised to the upside. Copper is tight because there were some supply disruptions that led to that tightening. So I think we're at a balance point now where you've got genuinely, you need even higher copper prices than today to incentivize the new production that we are going to need in 2, 3, 4, 5 years time to meet net zero technology trends. And that's just net zero trend. And we talk about AI data centers and amount of copper that's going to use. So there is a genuine demand pull for copper that at some point is going to pull copper prices higher. The question is, does copper take a breather now? Because actually that fundamental industrial demand, until we see China stimulus or the US economy picking up, perhaps isn't there as strong, as it needs to be to sustain the trajectory of copper prices. So it's a really interesting debate. The great thing about running a portfolio is we can hedge our bets a little bit by having a little bit less copper and a little bit more uranium or something like that in the mix to we don't have to make a big bet on any one particular commodity. But you've hit the right question there, Mike. Our sense is that it has continued to surprise to the upside, just the way gold continued to surprise to the upside as it rallied and went and set new records. And I think the risk is to the upside, but it's not going to in let's say the medium term. In the long term, it definitely is to the upside because the incentive pricing you need to bring new copper production in line, which if it doesn't come in, is going to create the price spike in its own right. But in the short term, yeah, copper may take a breather. It may take a breather for a while demand catches up with the price.
The other thing I would just add is that China's a big refiner of copper, and so the copper concentrate is in deficit. This year, the refiners or smelters there, they use some of their strategic stock as well as some recycled stock to sort of meet current demand. That's not going to last throughout the rest of this year. So at some point this year, those refiners are going to have to go back to the market to buy the higher price concentrate, and that's when you could see further upside. But it's hard to know given the kind of lack of transparency in terms of the strategic reserves in China, how long that's going to last. But it doesn't look like it's going to last through the rest of this year, at least the end of this year.
Paul, any thoughts on copper?
Yeah, I was going to say as well, I wanted to sort of make a statement as a question, really, which is, if we're in a situation where copper is only going one way, maybe there'll be some pauses along the way, and I want to bring back to your Adam Smith reference, because he's often misquoted anyway, Mike. I'm sure you wouldn't have misquoted him, but many people misquote him or use him to his own ends. But if we're getting to a point where copper prices are going that high, and we're facing bottlenecks, what does that mean for? Basically, we're talking about that for electrification, which is obviously on one level, but also in terms of EVs. Are we talking about a pullback where it starts becoming economically unviable to drive electric cars? Are we talking about massive subsidies coming in? And we're already seeing some the elements of protectionism potentially coming around that as well, and what sort of that can have an effect on price. I think we're getting to a point where. And I don't want to
I think the cost of renewable energy will go up, definitely.
I think that's almost that's a good point, Jason. I mean, that's ultimately it, is the cost of renewable energy or renewable energy infrastructure or electric cars is going to have to go up to respond. Now, there's always the argument made that actually the metal itself represents a very small portion of the overall cost, and it's all actually more in the manufacturing cost. But the reality is it's all additive to the cost of renewable energy. There's other interesting dynamics that happen around that. I think companies are really good at learning how to thrift and often substitute. So one of the trends that's happened historically is the substitution of aluminium for copper in electrification. Of course, that's good for aluminium, which is for its own reasons potentially heading for a supply deficit a few years down the road. But so I think thrifting, substitution, maybe some of the pressure gets taken off because you have a rotation into different vehicle types for a period of time. But yeah, I mean, ultimately, you're right, Jason. It means that actually the cost of having a renewable energy economy or a net zero economy is probably much higher than people recognize, in the long term. And not just because metal prices are going to be high, because of a lot of other factors.
Yeah, and this is the thing, the argument for the end of cheap energy. We've had a lot of energy complacency, and I think the end of cheap energy could well be over. Talk about where oil prices might be lower, but if oil prices are lower, it starts becoming, if you're talking about actually lower for longer prices, Mike, for oil, then we're in a situation where it could be an uncomfortable question for a lot of people when we're talking about security versus sustainability.
Yeah.
So the reference let me just finish this thought real quick. The reference I like to use a couple years ago, comparing Adam Smith to Thomas Malthus, is that invisible hand, and it kicked in a big time. We spiked energy prices for bad guys in Europe starting wars, and gave us plenty of incentive to do anything but use good old traditional fossil fuels from dicey sources. And look what's happening: 15% of I just took off sales for EVs, and I think more hybrids. I drive a hybrid. Mine's 10 years old, plug-in hybrid. But I want to tilt over to the two big picture macro elephants in the room. First of all, China. The way I see China is Huawei is doing to Apple what BYD is doing to Tesla. That deflationary forces out of the significant normal reversion processes in this rapidly growing emerging markets starting to revert, just like Japan, in my view, yet they didn't have that unlimited friendship that tilted the world away from them. So the key thing is, when I say I'm not so bullish coppers, I just look at bond yields in China. 10-year yields, 2.3%. That's 200 basis points less than the US. That's a sign of deflationary forces. So China, and then of course we have this little election. So I gave you my views. I see China's tilting towards Japan. It's a deflationary pressure on all market commodities except for gold, bullish for gold. And then also the election, the U.S. election. So I'll give you two takeaways. If we do get Trump 2.0, I see it's drill it well, bad for crude oil, and bad for the dollar overall, because his whole mantra is pressure the dollar, increase U.S. exports and things like that. So those are my two views, and two major. Let's just focus on the macro there. We have 15 minutes left. And those are also questions in the chat. How about we start with you, Jason, and get your views on those things?
Okay. I mean, I think China, China's been devaluing its currency. That's been a policy, they continue to pursue, which, also, it's undeniable that China has about 35% of the global manufacturing capacity. So they need to, aside from stimulating domestic demand, they don't have enough domestic demand to consume 35% of the global manufacturing capacity. So they will need to export. It looks like, the home shoring or friend shoring is breaking some of those integrated supply lines, despite the costs. It's the second largest economy, soon to be the largest economy. But, part of me wonders, Russia's been pushed closer to China. So essentially, China's now got a very easy source of cheap energy, cheaper than perhaps what they were paying before. So, weak currency, they need export markets. It'll get cheaper because of the energy. And I think they'll just find other trading partners outside of the West. And I think, if anything, the geopolitical risks will increase rather than decrease, which may seem obvious, but when you look at what China has going for it, it's pretty compelling. So, and they've tried to do some stimulus. The stimulus hasn't been what the market was expecting. Nevertheless, some of the tech stuff has come back in China. But yeah, I mean, I don't know if you had a specific question on China, but I mean, those are just some general observations on China and geopolitics.
Strong views. Appreciate them. Mark, your thoughts?
Yeah, I think what's interesting coming on China, I think, yes, it's really interesting, has access to cheap, well, not cheap energy, but readily available oil, from Russia. So that it's been a big strategic challenge for China, is sort of making sure it can get enough oil. But I think what's interesting is, despite the fact that it still has access to hydrocarbon energy, is that it's still pushing really hard to develop renewable energy technology and bringing down the price point. So I think coming back to the previous comment, will renewable energy be more expensive than people think it is? Yes, but may not be that much more expensive because of these deflationary forces that we've just talked about. And I think what's interesting is, despite having access to cheap oil, we are still seeing double-digit demand growth for renewable energy and EVs in China, and we're seeing the price point of those continuing to come down and down and down as the industry matures and they learn how to make things cheaper with less components or lower cost metals. And so, yeah, there's a trend there, I think. But yeah, I mean, China stimulus is going to be major. We can talk all about, these major supply demand trends that are going to evolve over time, which is going to be great for some commodities. But at the end of the day, if we're looking in the near term, it is how the China economy does, and that translate probably more to what kind of stimulus gets put in place to drive it. So I think that's going to be a key driver. You're right, Mike, and it's hard to see how that evolves.
Let's follow up on that and go to Paul. So do we have to depend on China's stimulus for commodities to go up, or is that the problem?
Well,
in my view, it is.
What I want to say about China is the panelists have talked about a few quite interesting points, and I think what's key, what we forget to talk about with China is actually coal. And it's not really a commodity we like to trade. No one wants to say, "Oh, we trade coal." We don't want to trade oil, let alone coal. But coal is such a big part of the economy, and when people talk about China's transition strategy or whatever, China's been strategically cynical about its own national security needs. It might be the fourth biggest producer of oil or fifth biggest producer of oil, but you never know it because it's so insecure. It needs to import so much. It's used oil as a strategic reserve. It's got secretive amount of oil in its strategic stocks. It's even used it in a kind of political weapon that the US SPR has kind of been based off of more recently. But the fact is that China is very cleverly talking, controlling supply chains, whether that's on the metal side or whether that's even on the coal side. And I think what'd be interesting when we talk about global supply demand trends, yes, it's about China's supply and demand trends, really, because their voracious appetite for all energy. And the question is really, part of the question is whether it's a barbell strategy, whether they're going to move to a situation where they have coal and renewables, or whether they kind of still keep the oil flowing because it's so important for their strategic needs, given how they're building out refineries, and petrochemicals is still a big part of the mix in any industrial complex.
I think there's that exact point you've made answers the question, because what you see is that the question, do we need China stimulus to make commodities rise? And I think what we're seeing is that the double-digit manufacturing growth in EVs, for example, and hybrid or other vehicle types suggests that, yes, it's not all being driven by domestic demand, but it is being driven by export demand. And they're bringing the price point to the level where actually maybe it's creating its own demand, because they're getting to the marginal, classic economics where you get to, you create demand by bringing the price point down. So, I think and I think maybe it is a barbell approach, because you're seeing unprecedented rollout of renewable energy generation in China. But you're also, as you've pointed out, continued high use of hydrocarbons. So my response to that is that, yes, I think this does look, there's a bit, if you call it the barbell approach to energy generation, but there's also actually a huge demand growth that really isn't depending on stimulus happening. That's happened, that we're seeing right now.
But the issue I have to point out is China's depending on the old model that worked for 20 years, and that's exports, and they unfortunately just piss off their best customers. Number one, the lesson I read from an economist, if you want to do well the last 100 years, you cozy up to US, and they just piss that off. Somewhat supporting this war in Europe, they're number one export customers. Look what's happening in Germany. Everybody's putting tariffs on all this massive supply out of China. And then you look at the book, The Price of Time by Chancellor, wrote about the value of the property crisis and the value of the stock market in China, when at their peaks were very similar to versus GDP of Japan, yet they were, the whole market's 5 times bigger. So we hope that works out on the positive side. But the last few minutes, I want to focus on, to me, the only commodity, so let's look at it this way. Historically, the best commodity from a total return standpoint is gold, historically. Now, please push back on it if you want, and it's still my number one, to me, best performer potentially this year, particularly if and or when we get a little backup in beta in the US. I mean, that unstoppable, the way I like to say gold is, well, why buy gold from a US standpoint when the stock market's on a tear and you're getting 5% T-bills? But central banks are buying it for good reason, most notably China. And to me, at some point, all those ETF outflows are going to flip to inflows once people realize the stock market just doesn't go straight up. So I'm still bullish gold. I think it's probably put in a pretty good floor around 2,200 in US dollars. It's on its way to 3,000. That's my view. Let's get your views. Jason, you want to start?
Yeah, sure. I mean, I think from a tactical standpoint, as Mark mentioned earlier, real rates are quite high. They should, over 2%, they should come down. Gold is typically inversely related to real rates. So as those real rates come down, particularly as inflation brings it down and the Fed cuts bring it down, you should see, higher prices in gold in theory. I think from a strategic standpoint, it's a store value, but I would just remind our listeners that it's not a very good inflation hedge. So, it is known for, being a way to combat against the debasement of currencies, which obviously you see, loads of issuance today and loads of debt relative to GDP, but it hasn't come out, it hasn't sort of kept up with inflation over time, over history, and it has effectively a zero beta to inflation.
What is a good inflation hedge then? Sorry to jump in, Mike.
Well,
some people say oil even.
So let me back.
Energy is actually a very good hedge to inflation.
Yeah.
So here's the thing I thought is a good inflation head over time is gold. I mean, if we're talking non-dollar inflation, currency debasement, and a basket of energy equities. So that's my thought. How about if we follow up, Jason?
I think go ahead, Jason. Yeah.
No, that's fine. Go ahead.
No, I think on the topic of gold, I think it depends what you take as your start point and end point in history as to whether gold is a good inflation hedge, because I think gold's inflation hedge is probably measured in millennia rather than quarters. So I think there's an element there that it does play a catch-up trade. So if historically gold should be at 2,700 if it was acting as an inflation head, it's 2,400. So you're probably right. But that suggests to me that actually there's a trade there where when the interest rate and inflation catalysts hit an inflection point, you can see how gold might gap up to where it should be to act as an inflation hedge. But so I think it's dependent on the time period you take to how effective it's been as an inflation hedge. I think the other thing is, which you forget, is gold's poor sibling silver actually does also react directionally with gold, and of course silver has a huge growing industrial demand base out of the renewable energy sector, which people aren't paying attention to as they focus on things like lithium and copper. So what you've got in silver, another traditional real financial asset, perhaps not to the extent of gold as being a reserve asset, that has a catch-up trade to do towards gold, and gold itself may have a catch-up trade to do towards inflation when rates come under control. So silver, I think, is very interesting as well as gold, Mike. But I would echo your views that gold is looking very positive. But I wouldn't forget some other metals as well.
But here's my issue with first gold. Gold is demonetized silver, so we know silver is an industrial metal mostly, and you point out good reasons for that. And there's a process right now, digital gold, little Bitcoin is demonetizing gold to some extent. I mean, biggest ETF launches ever were Bitcoin. Now we have a few minutes left. I just want to lay the land on that. So the key things I'm worried about is there's enduring trends. I pointed out the enduring trends of excess supply in U.S. and Canada and liquid fuels and petroleum. But the enduring trend I see, certainly since the financial crisis, is if you take gold versus copper, you take gold versus commodities, you take gold versus crude oil, gold versus silver. They're all on these big picture upward trajectories, and they've recently had dips. And one thing I overlaid recently is when the stock market U.S. gets really expensive and comes back, I just use S&P 500 versus 100-week moving average, rarely sustains much more than 22% above that level. It's just technical. But every time it reverts, gold outperforms almost those other commodities. That's what I'm worried is going to happen. Any thoughts on that when our closing comments? Jason, start with you.
Well, that's interesting. I mean, I think gold is going to be driven by underlying demand. It's going to be driven by real rates, less so by inflation. There are pairs of other metals that will affect the price of gold. Silver is probably the most prominent one, but you've also got the PGMs. And I guess the other thing we haven't mentioned is the strength of the US dollar, although you did ask about that earlier. But if you think that, so generally, because commodities, in particular gold's priced in dollars, if you think the dollar is overvalued or you think the dollar is going to weaken, typically that's also positive for dollar assets like gold. So another reason maybe for a tactical case for gold.
So final words from you, Mark, and then we'll end with Paul.
Yeah, I think there is a case to be made more broadly for gold to outperform for some other asset classes. Whether you could paint that picture so broadly for commodities, I don't know. I think there are other specific individual metal commodities that also have some very interesting drivers evolving over the next period, which whether they will perform better gold or gold will perform better than. I think there's a basket of 3 or 4 commodities in metal commodities that will probably together outperform everything else because of the whole variety of macroeconomics, geopolitics, and industrial demand trends.
Paul, you have the final word.
Well, I just want to just add, basically, I think over the next 5 to 10 years, or maybe take a longer view, is that the shifting geopolitical landscape is going to be very interesting for commodities. We've got, we haven't talked about the rise of BRICS and the kind of realignment of some of these sort of commodity-rich nations like Saudi Arabia and China, and how aligned they are, and what US's place is in that. And obviously, gold and the dollar are so strong, and people, I'm not saying they're going away anywhere soon, but it's certainly that landscape's going to be interesting over the next 5 to 10 years.
Okay, well, thank you, gentlemen. Thank you, Jason, Mark, and Paul. Really appreciate your input, and a little bit of discourse was good.